Welcome back to the Option Guy. Today, we are exploring a Greek that controls the weather of the option market, which is none other than Vega. If delta is about direction and gamma is about acceleration, Vega is all about uncertainty. It tells us how much an option price changes when market volatility changes. By the end of this video, you will not only understand Vega but also know exactly how it affects option pricing, strategies, and why traders sometimes make or lose money even when they are right about the stock. So, let's dive in. Now imagine this. The stock price hasn't moved much, but suddenly the option premium explodes higher. Why? That's Vega, my friend. Vega measures how sensitive an option is to change in volatility. Think of volatility like the weather. You can be driving smoothly, but if a storm hits, the entire journey changes. Vega is what tells us how much the storm will affect your option premium. And trust me, just like bad weather, Vega can either help you or ruin your plans. Now let's answer the question, what is Vega? Vega measures how much the price of an option will change if implied volatility increases by 1%. So, for example, if an option has a Vega of zero point 0.1 and the stock's implied volatility rises by 1%, then the option premium increases by 10 cents. So, even if the stock price does not move a single point, the option premium still changes. That's because of the volatility. Now, let's compare all the three to make it super clear. Delta tells you how much your option moves when the stock moves. Gamma tells you how much your delta changes. And Vega tells you how much your option price moves when the market's uncertainty changes. Think of driving delta is equal to speedometer. Gamma is equal to accelerator pedal. Whereas Vega is the weather outside. No matter how good a driver you are, a storm will always affect your trip. Now let's understand Vega with a simple analogy, which is airline tickets. If you are booking a flight in the middle of the week with no events, prices are stable. But try booking around Christmas or Diwali. Ticket prices skyrocket. Why? Because uncertainty is high. Airlines don't know the demand, so they price tickets higher. That's Vega in finance, guys. When volatility rises, option price rise because uncertainty is equal to higher premiums. Now let's take a practical example with the help of Apple stock. Suppose Apple is trading around $250. A call option is priced at $3 when implied volatility is 20%. Now, assume Vega is zero point 0.1. If implied volatility rises to 25%, the option premium jumps to $3.50. Notice Apple stock hasn't moved, but the option is suddenly worth more. That's pure Vega in action. Volatility priced into the option. Now let's compare Vega and the expiry, which is something critical to remember. Vega is highest for long dated options and lowest for near expiry options. Why is this so? Because uncertainty about tomorrow is small, but uncertainty about 6 months later, that's huge. So a 1% change in volatility has a much bigger effect on a 6 month option than a 1 day option. That's why long dated options are so expensive. You are paying for time and uncertainty. Now let's see how Vega behaves when an event is going to happen, like earning announcements, Fed meetings, budget speeches. This create uncertainty. Ahead of these events, implied volatility spikes and the option gets very expensive. But the moment the event passes, volatility collapses and the option premium drop instantly. This is called IV crush. Trader who bought options expecting a big move often lose money because volatility fell, even if they were right about the direction of the move. Now let's talk about being long Vega or short Vega. If you buy an option, you are long Vega. That means you want volatility to rise because your option becomes more valuable. If you sell an option, you are short Vega. You want volatility to drop because that deflates the premium. Think of it like weather again. A long Vega is like selling umbrellas before a storm. You win when the storm gets worse. Short Vega is like owning a picnic business. You pay for clear skies. Now, here's the risk. Vega cuts both ways. If you buy an option just before earning, premiums are expensive because volatility is high. Even if the stock moves in your direction, the option can lose value if volatility collapses after the event. That's why traders often say being right on direction is not enough. You have to be right on volatility too. Now let's quickly recap. Vega measures an option sensitivity to change in volatility. High Vega means long dated options, expensive premium. Low Vega means near expiry and little effect. Vega spikes around big events and collapses afterwards. If you're long options, you want Vega to rise. If you're short options, you want Vega to fall. So that's Vega, guys. The option Greek of volatility. Understand it, and you will never be caught off guard when option prices move even though stocks didn't. Ignore it, and you'll keep wondering why your PNL doesn't match your predictions. In the next video, we'll look at theta, the silent killer that eats away your option every single day. So, hit like, subscribe, and share this video and stay tuned because the Greeks may sound scary, but here we make them simple, clear, and funny for you guys.